How is an LLC a disregarded entity? Have you ever wondered how a limited liability company, often called an LLC, can be considered a disregarded entity? This is a common question, especially for new business owners. Let's break it down in simple terms. An LLC is classified as a disregarded entity, primarily for federal income tax purposes when it has only one owner. This type of LLC is known as a single-member LLC. If the owner does not choose to be taxed as a corporation, the Internal Revenue Service treats the LLC's income and expenses as belonging directly to the owner. This means that the LLC itself does not file a separate federal income tax return. Instead, the owner reports everything on their personal tax return. One key point to remember is that a single-member LLC is a disregarded entity by default. If the owner wants to be taxed as a corporation, they must file a specific form, known as Form 8832. This form is essential for changing the tax status. Even though the LLC is disregarded for tax purposes, it still remains a separate legal entity. This distinction is important because it provides limited liability protection to the owner. In other words, the debts and liabilities of the LLC do not affect the owner's personal assets. Many owners mistakenly believe that being a disregarded entity means they have no liability protection, but that is not the case. The simplicity of tax filing is another advantage of being a disregarded entity. The owner only needs to file one tax return, which can save time and reduce costs. However, it is also important to note that the owner is personally responsible for self-employment taxes on all business profits. This can sometimes lead to higher taxes compared to if the LLC had elected corporate taxation. There are exceptions to this disregarded entity status. If the LLC adds another member, it will no longer be a single-member LLC and will be classified as a partnership for tax purposes. This change requires different tax filings. Additionally, if the LLC elects to be taxed as a corporation, it loses its disregarded entity status. Even as a disregarded entity, the LLC may still have other tax responsibilities. This includes employment taxes, franchise taxes, sales taxes, or excise taxes. The disregarded status only applies to federal income tax, so owners should be aware of their full tax obligations. To avoid common legal mistakes, owners should understand that disregarded entity status is strictly a tax classification. They should also ensure they file the correct forms and report income accurately on their personal tax returns. Ignoring state tax requirements can lead to penalties, so verifying state rules is essential. Finally, owners should be cautious when adding members to the LLC. This change affects the tax classification and requires proper adjustments to tax filings. Consulting a tax professional can help navigate these complexities and optimize tax treatment. In summary, an LLC is considered a disregarded entity when it has a single owner and does not elect corporate taxation. This means the Internal Revenue Service treats the LLC's income as belonging to the owner, while still providing legal protection for personal assets. Understanding these details helps avoid common mistakes in business formation and tax compliance.